Good afternoon, and thank you for joining us for today's webinar, where we'll talk about the third quarter performance. We'll also just touch on some QCBI numbers, and David will talk about some credit risk. A couple of reminders before we get started. We will send out a link to today's recording, along with a copy of the slide deck. We will also include the results of the polling questions that we'll ask you to participate in. Likely, I'm not sure if we'll get it out today or tomorrow, but then try to tomorrow, if not, or first thing on Monday morning. My name is Shawn O'Brien, the president of QwickRate, and as always, I'm pleased to be joined by David Ruffin. David heads up our IntelliCredit division and will handle the second half of today's presentation. Just a reminder for those of you who aren't aware, beyond the QwickRate marketplace, we do have a couple of other product offerings, QwickAnalytics, where we provide comprehensive bank research and analysis tools such as CECL Solver, and becoming more popular again, the credit stress test done at the portfolio level. And IntelliCredit, we handle and provide third-party loan reviews, but we've also built a cloud-based application that you can use internally. We do use it in our loan reviews, but there are interesting applications in terms of portfolio analysis and internal and annual reviews. So just a reminder, if you haven't looked at IntelliCredit or QwickAnalytics, certainly encourage you to do so. Per usual, we'll just kind of touch on what's happening or what we're seeing happening anecdotally from our banks. We'll talk about the QCBI. We'll talk about credit, and then just again what's kind of new. And Sarah will come to this question here in a second. All right, we do have a few polling questions to start with for today's presentation. Certainly appreciate it if you'll answer in on these. But the first one is just around budgeting. Are you budgeting for higher or lower earnings in 2024, or just about the same are the three choices? But it's kind of strategic planning time for many of us. So as we were doing ours at the bank in St. Ann, where I'm a director, this occurred to me that this might be an interesting kind of question, because we certainly debated it within our group yesterday. So we'll give this just 30 seconds or so. We'll give it another 10 seconds, and we'll move on to the next one. All right, so we're going to end this one and we'll share the results. 20% higher, 41% lower, and 39% about the same. So thank you for participating with that one. All right, whoops. Oh, let me see. Stop sharing. All right, let's go back here. The next one is a familiar question. Where is, if any, the area of credit quality concern for you at the bank currently? C&I, consumer, CRE, or ag? I probably should have had multifamily on there. I apologize. I should have probably had that one there, but I'll give this again 30 seconds or so. Okay, we'll go ahead and end this one and share those results. So CRE is still the primary area, C&I, consumer, and then ag the lowest. So thanks again for participating with that question. Moving on to the next one, another credit quality. Are you seeing any deterioration, or do you feel any deterioration in credit quality coming? So okay, just about evenly split. We'll go ahead and end this one. Share the results. 51% said yes, and 49% no. So again, thank you for answering. Let's come to the next question. Just a couple of more. Are you still seeing deposit outflows at your institution? Again, pretty much the theme of this year around liquidity, but certainly deposit erosion continued here through the third quarter. So again, we'll just give this 30 seconds or so. All right, so a little bit better than last quarter. So 57% said no, 43% said yes. Again, something I think we'll probably be dealing with here for into next year, but good to see that it's improving a little bit for participants. And then the final, let's see. I don't know if that's going to launch. What concerns you over the next 12 months? Deposit costs, loan demand, credit quality. I'm not sure if that one's going to launch here. Let me see. Yeah. Okay. So let me see if that will try it again here. No. Okay. So we'll launch that one. But again, thank you all very much for participating in those. We did have a question come in. So for small community banks that are using the warm method, what other method are you running or suggest to run to compare to your results? Again, for our CECL solver, we're just using the warm. I mean, I think that's really the methodology. I mean, you're certainly welcome to use, an average maturity or something of your own, devices, but obviously you're gonna have to support it, and you probably have to answer why you're not using the warm, which is pretty widely adopted. So certainly I would encourage you to do that. I mean, I think you could look at the scale methodology as well, but certainly, Sarah, if you'd like to, we can follow up on this offline afterwards and talk a little bit more about it. Okay. Current state of banking, right? Just again, I think, to me, one of the most troubling things this year is just really this feeling that I've had since March of some, feeling of confidence, shaken in community banks, in the FDIC shield. That was really what got us through the financial crisis. But I feel like this time around, both by maybe some of the words of the Treasury, but also just in general, there's certainly a little bit of a renewed, shaken confidence in the FDIC and just smaller banks versus larger banks, which I think is really unfortunate. And again, I think hopefully the FDIC and trade groups will continue to work to strengthen that confidence for our depositors. I think the other thing is that with everything that's happened, we're continually seeing whether it's regulators or Congress looking to potentially look at some more bank related legislation. So I think that's certainly something for all of us to be mindful. Most community banks play at a disadvantage, obviously, to the larger banks in terms of regulation. So hopefully nothing else will be added that further exacerbates that disparity. Certainly, I think anybody who's been through a recent exam, one of these three topics have probably been the focus of it: liquidity, interest rate, risk, and capital. I think a lot of banks have been expecting credit to be at the top of the list, but I think anecdotally, again, I think this is kind of what we're hearing from a lot of our banks. And then I think increasingly, as we have spoken to banks, and the expectation is for slightly more challenging 2024. So we'll certainly see and continue to monitor that. I think earnings this year, I think for most banks, while have been challenged, I think have remained strong. Certainly deposits have been under pressure and will likely remain under pressure. The repricing of those deposits have really, highlighted the need for as many non-interest bearing deposits as we can. But I think, again, I think as we'll see in the numbers, at the median, NIM still improved for community banks. So that's encouraging given the significant rise in deposit costs. But the competition, not only from treasuries, but from fintechs, other broker dealers, our deposit dollars, our best customers are going to be continued to be, under pressure as we move into next year. These lower deposits and higher liquidity level requirements are going to, probably for some of us squeeze our lending, appetite. It's certainly tougher to price loans with at the margin with higher deposit costs. Your regulators are certainly looking at deposit duration, and again, maybe just asking for, and I heard for the first time yesterday in talking to, a bank consultant, a regulator asking, for a specific level of liquid assets to assets at the bank. So I think, I think we're obviously very, at the beginning of this, but it wouldn't surprise me to see maybe more direct asks like that. Again, I was surprised, but I think it's certainly possible to see more of that in the next 12 months. I think there is certainly continues to be an expectation that credit costs will rise next year. I think a lot of it obviously will be geographical. Some areas, are probably not there yet, but there's certainly markets where the expectation is that they will see rising credit costs into next year. And then again, I think as a go forward, there's going to be a renewed focus and scrutiny on our asset liability practices and communication to the board, as long with our liquidity management, and again, communication to our board. So again, I think it's a lot. It's one of those things, we know what we need to do, but we do need to continue to document that and make sure interested third parties such as regulators and auditors can see not only the good work that we're doing in the bank, but that we are also documenting it, the communication process, to make sure everyone is aware of it. I think in terms of liquidity, I think, again, focus on your contingency funding plans. I do think and encourage you to consider, scenarios of stress where you might, experience liquidity difficulties, and identify the steps that you would take to address those. Again, I think NIM will be under pressure as we move into next year, with the likelihood that deposit costs stay high, competition for those deposits stays high, and for some or many of us, we might just see a reduced appetite for lending. So again, I think NIM will probably stay under pressure. I think we have certainly seen from our banks and heard from our banks, and for them through their regulators or auditors, the need for stress testing. Obviously with QwickAnalytics, we provide that at the portfolio level, and then through IntelliCredit can provide that at the loan level, that David will talk about a little bit later. But again, I think that's starting to position itself. Again, it's an exercise that can be done pretty, I don't want to say routinely, but we've got a lot of the data work done for you in QwickAnalytics. So it's probably something to think about as you move into year end, just kind of, again, identifying that capital cushion. This is strategic planning time for a lot of banks. So again, be thinking about, your internal SWOT analysis, and then just, how the external macro conditions, might impact you at the bank. And again, I think if you do anticipate any credit issues, something I'm sure David will mention, but we certainly, hear from other folks in the industry, is just that, making sure we've got the staff within our bank to deal with, any potential credit issues, right? A lot of the workout talent that has existed in our industry, has left. So again, I think we have to kind of, look to ourselves and make sure we've got the staff and experience to potentially get ahead of any credit issues or issues with our borrowers as quickly and as effectively as we can. I added this slide as really yesterday after we were kind of going through our strategic planning process, and just some things that we talked about that I just thought I'd share. Obviously, you're trying to put together an actionable plan. You're taking into account a lot of again, just SWOT analysis and things that you kind of give yourself a healthy self-review. And I think for us, one of the things that as a smaller bank, we were really focused on was our need to continue to try to build our team. We've had a very experienced team, but now as with some retirements, trying to fill critical positions at the bank in a smaller community can be very challenging. So I think it alerted us to just a renewed focus that we needed to have on trying to develop either internally or just by by bringing in people who are new to the industry and trying to train them. That's a particularly daunting task at times, but for us to continue to grow and service our customers, we really recognize the need for us to try to continue to better be ahead of finding and identifying critical team members. Certainly pricing of deposits and loan and having some discipline around that is going to be increasingly important next year. Obviously a renewed focus. There's always a focus on seeking out deposits and non-interest bearing deposits, but certainly that's never going to be more important than in the next 12 to 24 months. And then I think we debated this quite a bit. I think for us, our area, we still feel like there's good lending opportunities with strong borrowers. But there is obviously a renewed focus to make sure it's high quality borrowers, and then we can get the pricing that we need. I'm reading a question that came in. It's regarding loan growth trends. So we're gonna touch on a little bit of this when we get to the QCBI numbers. So I'm gonna come back to this one in a second. The final couple things before we get into the QCBI numbers is just a problem that continues to concern me is just the level of underwater security portfolios. This is again a graph that I've just updated every quarter that shows you the number of banks who are under 5% tangible capital when you take into account the AOCI adjustment. You can see from 6/30 in almost all of these buckets, we increased. We went from 16 banks at June 30th with less than 0% tangible capital to assets to 30. And even the number between 4 and 5% has jumped. But across the board, this number jumped. Now, fortunately, the last since November started, the 10 years come down quite a bit. But I think the thing that really troubles me about this is it does create a paralysis for an institution who might be experiencing this. Certainly there's articles this week in the American Banker about banks who have the capital deciding to bite the bullet on some or all of their AOCI adjustment and take those losses. That's not an option for a lot of banks. But as we move into next year, and the potential for maybe some increased credit costs, it just concerns me. So again, I don't necessarily have a solution, but it's just an area that continues to concern me because it does really just, as you can see on this page, it really is going to influence and is already influencing bank behavior. So it's just something we're gonna have to continue to monitor. But again, just from the outside, it just is an issue that concerns me. So let's jump into the QCBI numbers. Again, we're under 4,700 banks, nationally. You can kind of, again, see the breakdown. 67% of the assets are now for community banks. And again, we're defining that as, banks under 10 billion. There's 18% of the community banks hold 67% of the assets. So still a good, healthy number between 100 and 500 million. But again, the consolidation continues. So here is, and again, these numbers are last 12-month numbers. These are all the community banks. So you can see over the last 12 months, asset growth is just kind of stayed flat. But 37% of the banks did not see any asset growth at all. Again, kind of the usual slope of line that we see, or amongst these, with the larger banks still able to grow some, more of a challenge, for the smaller banks. Slide my toolbar out of the way here. So we did have a question on loan growth. What are we seeing? So here again, over the last 12 months, lower than we had seen for the calendar year 2022, just slightly under 9% at the median. These again are median values. 44% of the banks, community banks, did see 10% or more of loan growth, and 11% saw 0 or less contraction in loan growth. Again, This one's a little bit tighter, which is nice to see, but you can kind of see by asset size, what those loan growth numbers, are over the last 12 months. Deposit growth, obviously here we've seen a negative number here over the last 12 months. Particularly, interesting, or is 54% of the banks, had zero or less deposit growth. So, our question was, are you still seeing, erosion? In our polling question, this kind of confirms it. Half the banks are experiencing, still some type of deposit erosion. And you can see, and this is again what's slightly more concerning, is it is most deeply felt in the 0 to 100, and then in the 100 to 250 million. But again, larger banks have gained a little bit. We're feeling the pain a little bit more for the banks under 500 million. So again, just an area we have to continue to monitor. I don't think the landscape is probably going to change anytime soon, particularly if we stay higher for longer. There's just going to be repeated pressure, on our depositors. They're going to be inundated with, whether it's through email, promotions, brokers. There's just going to be a pressure, saying, hey, you can move your money and gain more in a CD or some type of instrument, treasury, elsewhere. Performance numbers, again, I think encouraging to see over the last 12 months, a sizable repricing of loans has been able to be experienced by community banks. So we've seen a 97 basis point uptick there. Cost of funds, though, obviously much higher pricing, shock, if you will, right? We've gone from 38 to 160 on the median cost of funds. But, again, I think at least slightly encouraging is that NIM has held steady, 2 basis points higher over the last 12 months from where we were in 2022. And then again, you can see non-interest income numbers have, trailed down, but, at least kind of held steady a bit. And the efficiency ratio, has ticked up, which isn't all that surprising. As well. But again, I think still a very admirable job and a high quality and commendable job by community banks. This translates into median pre-tax ROA of 1.11, median core operating earnings, again, while slightly down, still at 121 at the median. You can see those represented here by the bank size. And then obviously the ROA and ROE numbers for banks at 0.88 at the median and 10.18 ROAE, which is still, really, solid and commendable for the community bank. So again, a really challenging, year, but I think all of you have done a tremendous job at managing your banks. At this point, David, you can take it away.
All right, sir. I always enjoy the visiting quarterly with the audience, and certainly presenting with Shawn. Hopefully you can see the screen.
Yes.
Super. I hasten to say this as a credit guy all of my professional life, certainly not in the doomsday predicting business. That's not very credible. And I think we live somewhat.
David, I don't see your screen. Sorry.
Oh, I'm so sorry. Let's see here. There we go. Hopefully we're seeing.
Well, we got your screen up, but not the presentation yet. Sorry.
There we go. Do you see the presentation?
Yes, now I see it.
Okay,
yep,
so sorry. So sorry. One of the things that, not unlike the polling question, which we were 50-50 on in terms of no deterioration yet in credit. And I think in many ways this depicts the kind of Wall Street, Main Street dichotomy we all live in. If you look at the most recent numbers, and some of the macro numbers is still talking about a fairly robust economy. The recession that got predicted for 23 didn't materialize. Some people are even saying as low as 15% shot at a recession for next year. But again, if you hear the Main Street aspect of the economy, and particularly as you get towards the consumer, levels, you hear frankly a different story. And I'm here only to bring these up because I think we also understand that these numbers that drive Wall Street and drive the public data and the call report data are, and to some degree, are trailing indicators, right? And we also know that those of you managing credit risk understand the very distinct correlation between early detection and reduced losses down the road if we do indeed get into heightened credit stress. So I do say this mainly in the under the guise of just being vigilant and being aware of where early detection red flags may be. And some of them are fairly, I think, obvious, that are different than they were and more troubling than they were even a quarter or 2 quarters ago. For example, we had the famous or the high-profile bank failures earlier in the year. They were all liquidity focused. We had a small bank in Iowa that failed just last Friday. I think for the first time this year, we actually had attributing to that failure credit quality issues. It happened to be that particular bank said they had trouble in their commercial trucking loan portfolios. We've had some regional banks indicate that they're suspending dividends due to preserving capital, some of which has become rooted in some credit quality problems. Interesting from an M&A perspective, 10 this year, 13 as of last year, M&A deals got called off, largely due to uncertainties. And if you read through the some of the narrative about that, a lot of those were uncertainties about some exposure in loan portfolios, particularly CRE. And so that is another thing we have to focus on. One of the things that we'll see more quantitatively in a moment through the QCBI numbers is that there still seems to be a little bit of an uptick in NPLs and net charge-offs for the first time in really a couple of 3 years among community and smaller regional banks, and some downticks or at least flattening of reserves. In other words, the larger banks in the last 2 quarters have seemingly increased reserves significantly at a higher pace than some of the smaller banks have. Certainly, the credit unions are beginning to experience heightened consumer delinquencies. I realize that the people on this call or banks generally, and certainly community banks, don't have anywhere near the proportionate exposure to consumer lending as the credit unions do. But I think it's a fool's errand to think that problems at the consumer level don't trickle down or basically move up into commercial, particularly as it relates to sales and revenue for income property loans and things of that nature. So we certainly have to recognize that. There are some regulatory surveys of late by the major federal regulators indicating certainly across the board some tightening, largely due to funding, as Shawn alluded to, and just general economic concerns. But then there's the clear issue of CRE. Shawn and I were in attendance in California last week with the CCBN Top Banker Performance Conference, and we heard not from vendors, not from credit guys, we heard from CEOs that said virtually across the board that they were being very discerning about making loans, the good quality loans now, particularly because of the squeeze on the funding, but also the reality that they knew that particularly as they were more involved in CRE lending, there was more of a target on their back from regulatory scrutiny. So I think discernment was a word we heard over and over used at the conference that I think is very appropriate here. Shawn alluded to this on multifamily. It's been an issue of concern for me for several months now, and that is because of the nature of multifamily lending, it tends to be kind of that seesaw aspect of 1 to 4 family. We all know the pressures that 1 to 4 family mortgage lending and home sales and all of that have had of late, even though some rates, I guess, have come down in the last week. Home starts, mortgage originations, they're at multi-year lows. What happens tends to be that the groups that are particularly starter homes move quickly to apartments and rental units. It just worries me that in some cases we're building some bubble in multifamily. In certain markets, you see huge amounts of apartment, and a lot of them high-end apartments being built. And again, traditionally over the many years, and I've been through many cycles on this, when mortgage lending goes up, multifamily often becomes a bit of a bubble. This has been an issue that obviously the numbers that Shawn alluded to has been some really robust growth in the last couple of years. When a year or two ago, when you shave off the non-organic the non-organic PPP activity, there was really anemic growth in the community and regional bank space that really threatened the profitability and the valuation models of banks. There's huge snapback that has come back in lending. Unfortunately, when you step back away from it, you may be looking at our space, communities and regionals basically gobbled up a lot more CRE to make up for that loan growth. And, again, we're looking at a dichotomy, a divergence between the strategies of growing CRE portfolio still as we speak by communities and regionals, while the larger banks and investor groups are moving in the opposite direction away from it. There certainly, of course, as that's been codified now through the June 29th interagency guidance, basically warning the industry that it is of some heightened concern, exposures in particularly high concentrations in CRE. And again, embedded in that was also admonition to the regulators not to overreact in that. But again, concurrent with that was it was imperative for banks to keep their CRE policies in particularly appropriate and pertinent to the current conditions. We've had several clients where we've done loan review for where they're 100% in adherence with their loan policies relative to CREs, but in the current environment, the loan policies that exist at the bank may be deemed by a regulator or even by ourselves as reviewers as a bit liberal and a little bit aggressive relative to what concerns there are in the industry now in CRE. So point being is look at your policies and tweak them accordingly to be more realistic about what maybe the environment is and the expectations are from either investor groups, the marketplace generally, and certainly by the regulators. I showed these charts last time, but I thought it was worthy of that. It just, I think, graphically and visually shows the incredible amount of growth that has occurred with CRE lending. I realize that has been not an uncommon characteristic of community and regional banks, frankly, since the mid 90s. But I think that percentage of going from 17 of community and regionals to 27% of the national market share just since the pandemic is really another example of why I think we as an industry are going to be under tremendous scrutiny over, in effect, why are we more comfortable with CRE exposure than larger entities or investors in the space in a broader sense. So let's take a look at some of the metrics. Obviously, as traditionally we do, we look at the 10 billion and under banks through our QCBI data, 10 billion in assets. These are broken down by the 6 regions that you have depicted in the various graphs. As you can begin to see, just generally, there is a little bit of an uptick in NPLs for the first time really in a couple of years since before the pandemic. Similarly to net charge-offs, although not significant, at least the graphs are beginning to make the turn. And as I alluded to a moment ago, the concern for me a little bit is that while we're beginning to show some increase in acknowledged NPLs or acknowledged problems, the reserves still at the community and regional banks seem to still be flat. The one regional kind of anomaly here that I think needs pointing out is in the Northeast, you see more, just slightly higher NPLs, but also lower reserves. Again, that's just a dynamic that a regulator is going to look at and just, if your bank falls into that category, is going to ask where is your comfort on that? Similarly, on the inverse of that is what percentage of your acknowledged inventory of problems are being covered by your reserves. That also, for our space, ours being community and regional banks, has begun to decline somewhat. So in other words, our coverage of acknowledged weakness, which goes right back to the point, is that, you know, we're not seemingly keeping up with the reserves, at least comparable to what the larger banks have been doing. Relative to the traditional look at CRE concentrations and the guidances that we've lived with for many years now, the broader category, which is to the right, the 300% guidance, you've got the Northeast and the West that are higher, and they reflect that in terms of the banks that are also exceeding that, but also the subset of that, which is the chart to the left, which is the construction and development loans to risk-based capital. You see, not surprisingly, the Southwest and the Southeast, where you got more demographic growth, probably economic growth, lead in that area. But again, you see the general trend of this continues to be at best even, not declining. We have the multifamily again increasing at the smaller bank area. That you heard what I mentioned a moment ago. C&I pretty much flat. Ag, of course, is, and I might add, go back, the one region that does seem to have the lowest exposure to CRE is the Midwest in both of those categories. But again, in ag, it's pretty much flat. But in this case, of course, the Midwest, not surprisingly, would lead the other regions because of their preponderance of farm exposure, ag exposure. And again, these are commercial bank numbers. They're not inclusive of the farm credit system. I'd like to conclude again by saying something a little familiar to you if you've heard these quarterly presentations, and that is we at IntelliCredit focus on these three critical concepts, and we think that this is also appropriate for you as banks trying to anticipate perhaps more credit stress in the near future, and that is relook at where you are on these three primary inputs to bank management. That's stress testing, portfolio analytics, and loan review. We know they're separate disciplines. They always will be to some degree, but frankly, the passion of IntelliCredit has been to try to put them more in sync together, give more of management and boards more synchronous information that comes from these three different disciplines, largely because I think we're going to all be put in a position to be much more, if you will, defensive about what our own credit script looks like, our own risk profile looks like, and our own ability to understand the data that is unique. And I must admit that, again, this is really the heart and soul of this exercise, is that the real DNA that you sit on is your loan data, right? That's not public data, it's your non-public data. And other than when a regulator is in the throes of an examination of your bank, no one sees this data other than you. But within that, there's a treasure trove of information about where your risk may be or where it may be emerging. And I think, again, IntelliCredit's a lot about trying to help smaller banks, less complex banks, get to par level of what a lot of the big banks are now doing very effectively, and that is understanding a good bit of that data and what that information can tell us. Remember, at that particularly as it involves the early detection of credit risk. The three things that I'll mention specifically on loan review, certainly this is the time to not decrease but increase loan review. Remember, if you're doing third-party loan review, or if you got independent in-house loan review, that is your agent, that is your friend, that is your one of your first lines of defense. They shouldn't be seen as someone you need to try to, as an adversary. It really should be seen as a first step to early detection of credit risk. The big recommendation we consistently make across the board is you need to ask, if you're doing third-party loan review, ask for bios, ask for experience level of reviewers. It's going to be more important, in my opinion, in the next 2 or 3 years to have people that have kind of been there, done that, know what credit risk is, particularly in the qualitative area, not just the quantitative, not just someone that can calculate a ratio, but understand the more subjective aspect of credit, which most of us in the credit world understand that really is the capstone for credit decisioning and credit management anyway. Use the business intelligence, as I just alluded to, that you're sitting on top of, make the best possible use of it through whatever tool you have. Again, IntelliCredit certainly likes to think we'll have given that tool to you at a practical and affordable way. But the truth be known is more work still needs to be done in our slice of the industry to be more sophisticated in understanding the portfolio analytical aspect, or the more macro trend analysis that is embedded in our portfolios. And finally, on stress testing, certainly Shawn mentioned that a number of times earlier on in the presentation, and that was the certainly growing need to do more stress testing. It's coming from auditors, it's coming from regulators. We provide that. You hear it a lot. It's either a loan level or a portfolio level. Certainly, the QwickAnalytics, our sister division, has a very robust portfolio level stress test. We're working on more sophisticated loan level, but what we offer even now, and is proving to be very popular, is a concurrent stress test along with the loan review. It's done literally concurrent with the loan review engagement, and it's basically an exercise of extrapolating various commercial purpose silos in your portfolio into what might be added stress on your in your risk-based capital numbers. So, Shawn, I will stop sharing, and at this point, again, I just want to thank you all for attending today, and as we certainly always look forward to meeting with you.
Thank you, David. All right, let me get my slide back up here.
I did see that someone did concur that in a recent exam that the regulator did ask for resumes of who was doing the external loan reviews. I think that is absolutely going to be a major change in the industry going forward, because I have heard anecdotally, frankly, from banks who've told us that regulators had felt that whatever loan review was being performed on them was rather superficial. And while that may pass muster during really benign times, I think as we get into a little more credit stress, it's going to be more challenging to approach it that way.
Agreed. And thank you, Jennifer, for offering that chat thing. I want to come back to the question earlier about just loan growth. Reading and hearing anecdotes of banks starting to curtail lending, which we would concur with, but average loan growth still seems to be a thing. Curious if you can add any color around loan growth. David, I'll let you offer any comments. I'll offer mine. Again, I think it's we have this at our little bank, right? So it's somewhat unique. I think there is an element. I'm always concerned about adverse selection. I do think there is also an element that certainly some local economies have unique catalysts that are continuing to spur economic growth. I think there's also a relative accretion of loans in instances where some banks have turned off the spigot, and so then customers are being kind of exposed to having to find new homes. So again, I think in general, I think we're certainly more discernment around the lending, but I also will say, right, I mean, the economy's still strong. So oftentimes unemployment doesn't start to rise after a year, or even potentially 2 or 3 years after kind of peak interest rates. And so we really haven't seen it start to slow down. I know the Fed and others would like to start to see the economy slow, but obviously annualized, the third quarter numbers were strong. So I think it doesn't completely surprise me there's still loan growth. I think at this point is something, I'll borrow something that David often says, is late vintage loans are often your most concerning if we do go into a downturn. So I think, I think there's still appetite for loans, but I think you just want to be more discerning. David, anything you'd like to add to that?
Well, I concur 100%. I think the issue here, I go back to this trailing aspect of kind of Main Street versus Wall Street, because Wall Street is driven by public numbers, right? And we saw an economist report that you shared just today saying the health of the average American consumer may be approaching again an area of very strong concern, i.e., paycheck to paycheck. So I do think, but I do think our biggest challenge is what I alluded to a moment ago, and that is we basically made up the loan growth at the community and small regional bank space with CRE. And the truth be known is that is a clear area of major focus. And I do think there are some bankers that honestly in our space that I think mistakenly blow that off as saying, well, we're not in big office buildings, we're not in big box retail malls, admittedly, but you're also financing huge amounts of strip malls all over the country. That's CRE, that's income property. So again, and unfortunately, it comes with the draw that you might be forced into a defense of your exposure in CRE, and that's another reason I think that you just have to be ahead of the curve around kind of writing your own credit script. But that's my biggest concern is we made up the gap on between anemic loan growth and fairly robust loan growth in this space, almost exclusively with CRE growth.
Thank you. Yeah. So I think, again, I think we're in the business of lending, right? We just have to be discerning at this time because, for many of us, there's a lot of things that just don't seem to make sense or feel right. So, I guess I'd say proceed with caution. Just a reminder on QwickAnalytics, a number of tools that you can use, including the CECL solver and the credit stress test. We do have some new tools to help too, just at this time of the year. We have the new net interest margin tool. Again, just kind of period to period, you can see changes both impacted by changes in rate and changes in volume. So certainly encourage you to look at that. If you haven't already, we did do a webinar on it. We do have the liquidity profile. I apologize. Somehow I forgot to include the screenshot of the credit stress test, but that's out there as well. I would also encourage you, again, I think, given where we are, we're trying to be ahead of this. David and the IntelliCredit team, we've done a couple of webinars now with bankers who are using our tool. Again, I think we could come on a webinar and tell you, why we think it could help you. We've taken the position that we'd rather have our banks tell you how they're using it and how it's helping them. So if you haven't watched this most recent one with Mitch Moss, a credit analyst from Outdoor Bank in Kansas, I'd encourage you to do that. There was also an earlier one as well. So again, they're out there in the webinar under our tab. You can view those as well. Let me make sure there's any question. Thanks, Mike, about a more robust M&A model. Yes, it's certainly something we've talked a lot about. I will say it's on the list. It's not at the top of the list. Those can be pretty involved. So, I think what we're more likely to do there is try to develop something which we already, kind of have, and try to do something that we think could be helpful in Excel, through the add-in tool that we think could be beneficial to our banks. So again, I think that's something that, we're working on, but it's not quite at the top of the list, as David said. There's a huge focus on stress testing. So right now we are really focused on developing within IntelliCredit the ability in our application to do some loan level stress testing in the application. On the QwickAnalytics side, we've got liquidity stress testing that we're working on and trying to get out. We're a little bit behind, so those are at the top, but certainly M&A is on our list. So we'll keep working on that.
Shawn, if I may add to Mike's question, I think it was rather a very pertinent one. We certainly believe that part of that is, of course, the credit mark. I think you may be alluding to on the discount applied to a potential portfolio being acquired or looked at or merged with. And what we're big on, and one of the reasons we're a little delayed in getting that model done, is we're philosophically believing we need to turn the page on just a total fixation of net losses. That is just not dimensional enough under the current environment. If you look back 10 years, we haven't had losses in the bank. So why would we fixate on net losses? And yet so much of the traditional model for credit mark work is it's kind of the NOI or the cap rate of the credit mark, if you know what I mean. No, I'm talking to the credit people more in this, but the reality is, to me, who cares? We don't have any data that shows a lot of loss. So we're adding other dimensions: gross losses, non-accrual, a pattern of deterioration within the week. The pass credits down to from mid-tier to weak pass. To us, that makes more sense to create a more multi-dimensional credit mark than just the fixation on net loss.
Awesome. Thank you, David. So yeah, we're gonna keep trying to bring new tools to both IntelliCredit and QwickAnalytics next year. Continue to submit ideas. Like I said, we do have a long list. We're trying to work through them as quickly and as effectively and efficiently as we can. But like you, we want to continue to add functionality to try to make your life easier. And if there's something we can do more efficiently, we're certainly aiming to do that. So on behalf of David, we want to thank you for your time today. You guys make these great. We really appreciate you taking time out of your day to join us. Look for future webinars coming up. Certainly encourage you to get a tour of IntelliCredit, or even if you're looking for an RFP for next year for a loan review, give David and reach out to the IntelliCredit team. We're certainly here for QwickRate and QwickAnalytics if you need us. And again, hope you have a great long weekend, and thank you for joining us today. David, any words before we let him go?
No, echo everything you just said. And we'd love to talk to you about, we know this is not only strategic planning, it's also RFP for next year's loan review. And just echo that. We'd love to talk with you.
Great. Well, thanks again. Thanks for joining us, and we will see you next time. Bye now.
Bye-bye.